I would attest to you that there are no limits to that, and that the next decade will again demonstrate that, quite frankly, we may only be in our infancy in terms of our ability to do that, no matter how sophisticated that we think we are today. I don't think it's an exaggeration to say that insurers today are engaged in what I would call a technological arms race, and they do this to gain an underwriting advantage. Most people think about competition in the insurance industry as one that's based on price, but in fact, while it is a competitive industry based on price, it's at least as competitive based on underwriting acumen. In other words, better able to discern risk and assign a price to a particular type of risk. So there's more information available for insurers, and what this also means is that they are more accurately able to price risks. But for consumers looking to buy insurance or who are participating in insurance markets in any way, it has been also a transformational decade, which has empowered them in a way that they've never been empowered before. Most obviously is the way that they shop for insurance. They have an increased number of options at lower average prices, and this is again a trend that will likely continue out through the next decade. So there's a transparency in terms of prices has increased dramatically over the past 10 years. I mentioned that prices on average have fallen when you measure, say, relative to incomes or relative per unit of risk being insured. Again, it's quite possible this will continue in the next decade. And then one other measure of digitalization that falls directly from an enhanced ability to collect, analyze data is reduced incidences of risks that cannot be underwritten. I don't think this is commonly understood, but the size of markets of last resort within the United States, at least, have shrunken dramatically as underwriting sophistication has exploded. So this means, for instance, individuals with poor driving records. Very, very few of them are insured by state-run markets of last resort anymore. And in fact, only in markets where there's an extraordinary amount of regulatory interference are ones that are of any size. If you go to the next slide, please. I'd also like to make a note about one of the a mega trend I think that a decade ago has been proven to be wrong. A decade ago, there was the view that insurance distribution, while it would be transformed, and that much of it was correct, but that transformation would involve the extinction of the insurance agent. That has turned out to be, nothing could be further from the truth. And in fact, as you see, I've showed basically market shares for direct, and direct here means not only internet and telephone, but also means exclusive agents versus independent agents, which is what is meant by agency. You actually see that the overall shares have not changed dramatically. Yes, have there been gains by some pure internet insurers? Yes, that has happened. However, the mega trend that we began to see in the last several years of the past decade, and which will likely continue in the current decade, is what I refer to as channel fusion. Consumers, rather than looking to purchase insurance exclusively everywhere and at all times through one channel, have decided that they would prefer to deal with a multiplicity of channels, whether that is the agent, whether that is the internet, whether that is the telephone, or whether that is the company directly. And I expect that model to continue to move forward. But I think any assertions that the era of the independent agent are over with were incorrect a decade ago, and they are incorrect today. So, Jay, with that, I'd like to turn it back to you.
Yeah, I would just start by picking up on your comment, Bob, which is for Fireman's Fund, the independent agent is key, especially in the markets that they deal with in the commercial segments and the more affluent segments. Nonetheless, our sense is that the internet technology and data will transform the insurance industry. Maybe not so much in the distribution area or just in the distribution area, but certainly in terms of new risks that are likely to be insured, as well as there are new opportunities for insurers to use data, for example, in the area of pay as you drive. Not only is that happening, but the world is becoming increasingly interconnected. Today, 27% of the world's population is connected to the internet, and in the next 10 years, that will increase to 40%. This presents opportunities, but also threats for companies, particularly those that don't respond to these trends. Those that have the better data and the ability to use that data will be the winners. Customer relationships will also be challenged, but nonetheless, the relationship with a person will continue to be increasing of importance. Our sense is there are also legal issues that are presented as you collect this information and as you collect this data. Where does the intersection fall between personal privacy versus understanding and a better understanding of the risk? For example, do we use information about erratic driving or speeding as a basis to price policies? If we go to the next slide, you'll see that telematics is an area, a new frontier. This is the idea of pay for use. And this has implications in product design. It has implications in claims management. For example, in a crash claim, one could challenge false claims as a result of information that's being collected. It has also content with respect to risk management and the prevention of loss through remote diagnostics. And then we think that there are many value-added services that can be provided by insurers to both fleet customers as well as individuals, for example, in the area of roadside assistance. And I think that leads us to our last mega trend, which is the area of demographics.
Thank you, Jay. Yes, demographics. And Jay and I will discuss basically two different issues, and there are many dimensions to this, of course. I will talk briefly about some areas where demographic shifts may translate directly into changes in risk that matter significantly to how insurers price and underwrite certain types of insurance. I think Jay will talk later about some of the wealth-related issues associated with it, and these are occurring really on a global scale. Just to give you an example of where there are immediate concerns, we can take a look at what is happening with respect to injuries in the workplace associated with various age ranges. Now, as we all know, the average American worker is getting older. In fact, it's getting older at a fairly rapid rate now. It well exceeds 40 years old. In parts of Europe, Western Europe in particular, it will be even older because we do not have the same strong immigration that we have here in the United States. So what we see, for example, when we think about workers' compensation, which is the second largest of all commercial lines of insurance, we can see that the likelihood of an individual 65 years or older being killed in the workplace is triple that of someone who is between the ages of 35 and 44. That has extraordinary implications given the rapid increase in the number of seniors who are remaining in the workforce, and quite frankly, we can't really consider a 65-year-old a senior anymore. The numbers of older individuals entering or remaining in the workforce will be higher even than any projection recently would have estimated, and the reason for that is because of the financial crisis, which will keep people much longer in the workforce than they had anticipated. I would expect that to translate into potentially higher death rates in the workplace. And so what this suggests is there are risk management opportunities and necessities that both employers and insurers will need to address. I will say that when insurers and employers put their heads together in terms of reducing workplace injuries, this has been a success story for many, many decades. And I believe that through analysis, through technology, and through proper incentives, these fatality and injury rates can be reduced.